Greetings, salutations, hazim in my stat. However you say it in your neck of the woods, I'd like to welcome you to another episode of The Art of Reading Price Action. Again, welcome to another episode of The Art of Reading Price Action. And in this episode of The Art of Reading Price Action, we will be discussing the reclaim block. Market Maker Models Part 3, the reclaim block. Now, before we get into it, again, if you don't know who I am, my name is Timothy Lee Rogers Sr., aka Aranya Grande. That's Big Spot for those that don't hablo Espanol. And if you're wondering how to join the paid portion of this mentorship, there is a join button in the description or somewhere on the screen here down below, a join button so that you can join. Just pick the tier that says mentorship. It's $24.99 per month for the mentorship. Yes, we're in week 18. So if you're just coming aboard, don't feel pressured to try to catch up with everybody else. It's a self-paced mentorship. We meet every Wednesday night for homework reviews. When we have homework, we meet every second Sunday, that is, for the mentees. The first and the third Sundays, you have access to those Q&As, but the second Sunday is dedicated specifically for the mentees. So again, 3 Sundays at 7 p.m. First Sunday, second Sunday, third Sunday, you have access to Q&As. The second Sunday is just for you, the mentees. And Wednesday nights at 7 p.m. for homework review when we have homework. And you also have access to me via the Discord, and I do random pop-ups. They say I stay popped up. We got a channel in the Discord called I Stay Popped Up. Now, without further ado, let's get into another episode of The Art of Reading Price Action. Turn your attention over there, please. Over there, on that side of the screen. Not on me anymore. Over there. Now, this is Market Maker Models Part 3. And we will be discussing the reclaim block. Now, there's 2 different ways that Michael teaches the reclaim block. In this episode, we're going to be talking about the reclaim block in reference to market maker models, because that's what we're on. We're on market maker models. Before we go on, I want to reiterate what I said in part 2 of the market maker model series, that we should stop looking for patterns. We're not looking for patterns. The market maker models is a specific set of criteria that leads to probabilities. And we also know that during this market maker model, IPTA, the algo, aka the market maker, will engineer liquidity and then reprice to a very specific point. And we like to call that point an anticipatory reactionary point. Then it will reprice back to the targeted liquidity while offsetting hedges. Right? Remember, it's all about the hedges when it comes to big money. If you got big money like IPTA, if you got big money like these institutions, you have to hedge. You have to hedge into your positions. Now, let's get into it. Let's look at a market maker sell model first. As we know, with a market maker sell model, we got a sell side on the left and we got a buy side on the right of the market maker model. Now, first thing you want to do with market maker models and any concept dealing with ICT, you want to make sure you have a clear draw on liquidity, right? This lets you know when you're supposed to be looking to the left, to the left. Everything you need to know is always to the left. It's always over here to the left. But if you have a clear draw on liquidity, you understand when you should be looking to the left to find these reclaimed order blocks that we're going to be talking about. Right? Now, when you're speaking of the big money, IPTA, you got a lot of cash. I still don't know why I'm doing my hands like this. But big money, you got a lot of cash. They can't place their orders in one trade. They can't place their full order in one trade. They got to scale in, right? How do they scale in? They scale in by doing something known as hedging. In a market maker buy model, the bias is bullish, right? The bias is like, you want to have a bullish bias when you see a market maker buy model developing. But before it attacks the buy side liquidity, right? Before it will engineer liquidity, and before it attacks that buy side liquidity, IPTA will reprice down to a very specific PDub rate. It's already predetermined how far IPTA will reprice down. It knows how far it has to go to allow itself to scale in to all the positions that it needs before starting to go back up. So it's already predetermined how far it will go down, right? So when IPTA wants to get long, or when institutions want to get long, the market maker, aka IPTA, will start to reprice lower. And as it's repricing lower, it will start to hedge into long positions, right? It will start to create bullish order blocks on the way down. Tim, what are you talking about? Let me show you, right? When you start to see these bullish order blocks forming on the sell side of the curve and price is bullish, right? You're not getting tricked into trying to go long over here when you see little pops. Like the pops is a indication that hedging is taking place. Right? So as we're coming down and you see a down close candle that creates a pop, a short-term displacement, this is evidence that hedging is taking place. IPTA is going, now, mind you, it's not going to just be 3 times down every time, right? It's the narrative. We're not looking for patterns. So if you're bullish and you see price consolidate and an engineer liquidity, and then it starts to reprice down, right? And you're bullish, you're focusing on the liquidity above that initial consolidation. And as price sails down, when you see down close candles start to create short-term displacement, creating a short-term low over here, it creates displacement. That's evidence of IPTA hedging into long positions. That's why you get that little short-term pop, that short-term displacement, right? Informed traders that's more advanced, this is when they take advantage of what they call selling the rip, right? You don't want to be buying a dip over here on the sell side of the model when you're bullish, right? When you see that short-term displacement, don't make the mistake of buying a dip when you're on the sell side of the model. How do you know if you're still on the sell side of the model? Because you haven't reached your anticipatory reactionary point. You haven't reached your higher time frame PDub rate. You haven't reached that breaker, that bullish breaker. You haven't reached that bullish order block. You haven't reached that old low, that old equal lows, or that old swing low. You haven't reached that higher time frame PDub rate. But once you reach that anticipatory reactionary point, you will get a smart money reversal and price will start to go back up on the buy side of the curve. Now, let's see the definition of a reclaimed bullish order block. Bullish reclaimed block is a candle or bar, just say candle, we don't look at bar charts, that was previously used to buy price in a short-term bounce confirmed minor displacement. Remember I told you, when you see that short-term displacement, that's your clue that they are hedging into long positions. Again, right? It's a previous candle that was used to buy price in a short-term bounce confirms minor displacement. When you get to the buy side of the curve, right? These, when you look to the left, on the buy side of the curve, these old blocks will be used to reclaim long positions. So they're scaling into longs, scaling into longs, scaling into longs, smart money reversal. And then when you start going up on the buy side of the curve, reclaim the order block, reclaim the order block, reclaim the order block. So How do you identify it? When price moves back above the old bullish order block, so the old down close candle that caused a displacement, when price trades back above that on the buy side of the curve, you look for price on the buy side of the curve. When it trades above the bullish order block that's on the sell side of the curve, you look for price to trade back down into this down close candle over there to reclaim longs. And price will do this or reclaim these order blocks until it reaches the draw on liquidity. Now, Tim, you said a whole lot, and you're showing me this little victory V shape here. What does it look like on the chart? It looks like this, right? You identify a market maker buy model, right? Look at a market maker buy model. See, we're in a market maker buy. You identify the market maker buy model. And when you identify the market maker buy model, you want to split it in half. Now, this is when you're studying. So when you're studying, you want to split it in half. And then you want to look at the buy side of the curve and look back at whenever the buy side of the curve pulls back with a move like this, is go up and pull back. Look to the sell side of the curve to see what is it reacting to. When we went up, what did we react to? When it went up, what did we react to? Look over there. It's reacting to bullish order blocks. It's reclaiming bullish order blocks. When you have a down close candle over here that created a pop, it's trading back down into the down close candle and reclaiming longs. It's trading, it closed above, traded back down into the down close candle, right? Reclaiming longs until it pushes up until into the draw on liquidity. Those are bullish reclaimed order blocks. Now moving on to the market maker sell model. It's pretty much the same. It's just in reverse. So we'll go through it quickly, right? Relatively quickly. You got to have a clear draw on liquidity. You got to understand that price is truly bearish, right? When you start to look to see if a market maker sell model is forming, you want to see a consolidation, an initial consolidation, and then price start to reprice up towards an anticipatory reactionary point. As price reprices up to an anticipatory reactionary point, it will start to create bearish order blocks or up close candles that create a short-term high, pushing price down for a minor displacement to the downside. So as it goes up to the anticipatory reactionary point, you'll have a smart money reversal. And then as we start coming down the sell side of the curve, it will start to reclaim those order blocks for short positions. Now, let's look at the definition. Bearish reclaimed order block is a candle or bar, we just talk about candles, we don't look at bar charts, that was previously used to sell price, and a short-term decline confirms minor displacement. In the sell side of the curve, right, that's over here, and the sell side of the curve, these old blocks will be reclaimed for new shorts. So as price trades down past the old up close candle that created the short-term drop in price, price will trade back up into those up close candles to reclaim shorts. Drop down past these old up close candles that created a drop in price, and it will trade back up into those up close candles to reclaim shorts. Now, let's look and see how it look in price. It looks like this. So you want to, as you're studying, again, you want to focus on the market maker sell model. You're looking, for an obvious market maker sell model. You want to split it in half, right? You split the model in half, and then you see on the sell side of the curve, whenever price came down and retraced back up, you want to look over to see what was it reacting to. When price trades down and it reacts back up, what was it repricing to? Okay, it was repricing to this. If you notice, as price came down below this up close candle that created a drop, right? As it went below it, it traded back up into that up close candle. as price traded down below this up close candle that created a drop, it traded back into that up close candle on the sell side to accumulate more shorts. And then when it traded below, you get the picture. It accumulated more shorts until it went down to the draw on liquidity. And that is the market maker sell model. Now, for our favorite part, let home work. I want you to go back through price and take detailed notes on what price did during market maker models, buy models and sell models when it was reclaiming order blocks. So again, go through the price, find clear market maker buy models and market maker sell models, split it in half. On the buy model, look at the buy side of the curve, and then take detailed notes on whenever price traded up and retraced back down. Look to the left and look for the reclaimed order block, the down close candle that created a popping price on the sell side of the model. When it comes to the market maker sell model, look on the sell side of the curve, and whenever price traded down and popped up, look to the left and see what up close candle or the reclaimed order block that price was trading back up into to reclaim more shorts. You pick the time frame that you want. Just find clear market maker models and use the ES continuous chart on the TraderView platform. That's ES1 exclamation point. And with that, that brings us to the end of another episode of The Art of Reading Price Action. Again, my name is Timothy Lee Rogers Sr., aka Aranya Grande. I appreciate y'all for hanging out with me, man. Y'all be safe out in these trading streets, man. I'm gone.